Hey everybody, Smart Silver Stacker here. Hope you're doing well. At least I hope you're doing better than the banking system here in the US or in the European Union. Of course, that's not setting the bar real high these days as this financial crisis that we find ourselves in the midst of continues to worsen. The latest development is that UBS has agreed to purchase troubled European bank Credit Suisse. Although it doesn't look like that's going to be the end of it, because this has opened up a whole new can of worms in the European bond market, and also looks like it has created the potential risk for a collapse by UBS. So we're going to get into that in today's video. And while all of that is happening over in Europe, here in the US, the Fed appears to have abandoned its program of quantitative tightening, of shrinking its balance sheet. And it looks like they're back on the QE bandwagon. Of course, that is not the official word from the Fed, but if we examine the chart of their balance sheet, it seems to tell us another story, and we're going to be taking a look at that later on in this video. But first, I do want to talk briefly about the effect that this crisis has had on the price of gold and silver, because both metals have been on an absolute rip since this crisis started. And, you know, I can't say it's too surprising that given all of the uncertainty in markets at the moment, that investors would want to be getting into hard, physical, tangible assets that they can put their hands on, that they don't have to worry if they wake up one day, maybe the price has gone to zero. That hasn't happened to the price of gold and silver in over 2,000 years, so it's not likely that it is going to happen today. I do believe that before this crisis ends, the price of both metals will be going much higher. Today's video is brought to us by SD Bullion. You can buy your gold and silver at sdbullion.com. Right now, new customers can get gold or silver at spot at sdbullion.com/new. So make sure you check that out. Now, let's talk briefly about this acquisition of Credit Suisse by UBS. So UBS agreed to buy up this troubled bank for 76 cents a share. Now, this is kind of a bailout because the Swiss National Bank and the Swiss government have made some assurances for UBS in the event that they suffer losses as a result of this acquisition. But despite the assurances, despite the bailout nature of this, the risk of a default at UBS is hitting a record high following this acquisition. And perhaps even more troubling is that as part of this deal, shareholders in Credit Suisse will be getting about $3 billion, but bondholders of Credit Suisse are getting wiped out entirely. Specifically, these risky Tier 1 bonds, they're called AT1 bonds. It's about $17.3 billion that's getting wiped out as these bonds are getting written down to zero. And this development has triggered a huge sell-off in the AT1 bond market in Europe today, Monday, this morning, as markets opened. And this looks like it could be a huge risk for the European bond market. Now, to give you an idea of the size of what was wiped out here, it's about $17.3 billion worth of these Tier 1 bonds that have been written down to zero. The entire European T1 market is about $275 billion. So that gives you some perspective on just how massive a write-down this is. With the stroke of a pen, more than 5% of this market wiped out. So, you know, it's not a small development. And also, to give you some perspective on this, this is the largest write-down on bonds in European history. The second largest was back in 2017 when distressed Spanish lender Banco Popular wrote down about $1.4 billion worth. So this is more than 10 times the size of the second largest write-down in bonds in the European market. So you can see why this is causing some market turmoil. Now let's change gears here briefly and talk about a different bond issue, and that is the issue that has really led to this financial crisis in the first place, and that is all of these mortgage-backed securities, these securitized mortgages, and also these bonds, the US Treasuries and other bonds that these banks have on their balance sheet. And what's going on in this rising rate environment? Well, as the Fed and the ECB have been cranking up rates to fight inflation, it has caused all of these bonds, these US Treasuries, other bonds, other mortgage-backed securities on these banks' balance sheets that are at a fixed rate, a very low fixed rate, because these instruments were created and purchased at a time when rates were much lower. It has caused the value of them to decline precipitously. Now, part of the narrative here that we've been hearing in this financial crisis is that poor risk management and just poor management in general at institutions like SVB and Credit Suisse is what is to blame. But there's a new study that I want to talk about here, which is conducted by the Social Science Research Network, which has revealed that nearly 200 banks may be affected by similar problems as to what is affecting SVB and what caused the collapse there, and also its signature bank. And when you look at this study, it kind of makes this narrative of poor risk management, poor individual conditions, not so convincing. Now, I believe that this systemic risk to all of these banks, more than or close to 200 banks, according to the study, is why the FDIC, the Fed, and the Treasury, they moved so quickly to bail out these uninsured deposits at Signature Bank and SVB. It was to stop the contagion related to these unrealized losses on these bonds from spreading, and to prevent these banks from having to realize the losses just like SVB did. That's why the Fed instituted this BTFP program, which is basically quantitative easing by another name. Now let's talk a bit about this study in particular, this one conducted by the SSRN, the Social Science Research Network. Now, according to them, bank assets in the US are actually about $2 trillion lower than what the book value of these banks indicates. Now, I think this has something to do with the buckets that the banks hold their bonds in, because they have the ones that are available for sale. Those are the ones that get marked to market, so they have to actually put on their books what those bonds are worth in the current environment. But they've got this other bucket, the hold to maturity bucket, where they have the majority of these assets, these bonds, which have unrealized losses sitting in. Now, these, they don't have to mark these to market, so they don't have to actually demonstrate the unrealized losses on their balance sheet, because they just keep them there at face value, at par. And also, according to this study conducted by the SSRN, SVB was not the worst bank in terms of capitalization or unrealized losses. In fact, according to this study, 10% of US banks have worse capitalization, and 10% of banks also have higher unrealized losses on these bonds. And really, the real risk, according to this study, has to do with these uninsured deposits, the deposits that are in excess of the FDIC $250,000 cap, which is still in place. I mean, despite the fact that it didn't play into the insurance for SVB and Signature Bank depositors, they're all being made whole, even the uninsured depositors. But technically, the FDIC does still have this $250,000 cap on what's insured. And according to this study, if half of these uninsured deposits get withdrawn from these smaller banks and moved into institutions that are perceived as safer, there are 190 banks that are at risk of failing and suffering the same fate as SVB. That is, if half of the uninsured deposits are moved. Now, I do think that all of this is why we are seeing this return to stimulus, to bailouts, and quantitative easing, because this problem goes much deeper than what we are hearing from the powers that be. Now, let's take a look real quick at the Fed's balance sheet. You can see here that the Fed's balance sheet has been drawing down as part of their quantitative tightening program, part of their inflation fight since about April of 2022. In fact, they managed to get the balance sheet down from $8.9 trillion to about 8.3. But then look at this most recent spike. It has gone up in the past week or so to $8.6 trillion. Now, I put out a video just a couple days ago in which I forecast that we would see $10 trillion on the balance sheet before we ever saw 8. And that was before we saw this spike on the sheet. But this, I think, is confirmation of that forecast, that that forecast was accurate. And it looks like the Fed is now back in the business of taking these troubled assets, these mortgage-backed securities and these U.S. Treasuries that have all these unrealized losses onto their balance sheet. And I think that was fairly clear when they announced that BTFP program, where they're taking these troubled assets as collateral for loans and they're taking them at face value, that that's exactly what is going on here. Now, part of the problem is that the Fed understands how risky this banking system is. You know, they understand that there's all these institutions, hundreds of institutions, that could potentially suffer the same fate as SVB, that could fail. And in today's era of social media and online banking, these bank runs can manifest themselves very rapidly. That's what we saw with SVB when Peter Thiel told depositors that they should get their money out. It basically triggered a run. Now, clearly, it was wise for depositors to try to get their money out because the bank was really insolvent and it did have all of these losses. But this just shows that the Fed and the Treasury and the powers that be here, the financial powers, they're going to have to really get ahead of these bank runs and this contagion, which is not under control yet. And that's why I think a lot more stimulus is on the way. And that's probably why gold is now near $2,000. And last week it had its best week in over 3 years. So clearly markets are starting to wake up to the risks that are present in this environment of contagion. Also, another development in the ongoing bailouts is that the Fed and 5 other central banks over the weekend announced that they would be boosting liquidity by enhancing US dollar swap arrangements. Now, this is something that they did back during the 2008 financial crisis as well, so it shows you that we really are in the midst of a financial crisis here, and there is a real liquidity problem. And I think that the Fed, their game plan is probably to provide as much liquidity that they need. It's all going to depend on if they can really get ahead of this contagion and prevent more cascading bank failures. And that'll determine, how much stimulus we get. But it does appear that when we look at the Fed balance sheet that the pivot is in, that the pivot is here. They are now taking assets back onto their balance sheet. They're going to be monetizing debt through further quantitative easing. And I think that before this whole crisis is over, they are going to be creating a tremendous amount of dollars and pumping them into the system. They're going to do whatever it takes to provide the liquidity necessary. I mean, they've really kind of tipped their hand now at this point, and I think we know which direction is going. Now, will they be able to prevent a full-blown banking collapse? Who knows? Maybe. But if they do, it is going to be at the expense of the purchasing power of the dollar and much higher inflation. Keep in mind that the last time these stimulative bailouts occurred, it was at a time when inflation was very low, and now we are already at an official CPI of over 6% or around 6%. So, expect inflation to go much higher if they continue to pursue these bailouts, and it looks like they are. I mean, every day it appears that there are some new interventions in the works. So to me, it does appear that that is the path we are on. And even though the metals, gold and silver, have had a pretty good run over the past week, I really think that this is just the beginning. And before this is all over and before this next round of stimulus is finished, I think that both metals could very well be hitting new all-time highs. That would mean over $2,000 for gold, over $50 for silver. And it is possible that we may even be seeing new inflation-adjusted all-time highs for both metals. That would mean more than $2,600 gold and over $170 silver. So, brace for that, because it does look like this could be the mother of all financial crises, and there's going to be a lot more stimulus on the way. Now, we'll get a preview, get a better idea of what we'll be seeing as this crisis moves along over the next couple of days at the next FOMC meeting. As for me, I am expecting a pause in the rate hikes, and I think that that will really confirm that the Fed pivot is here. When we look at the Fed balance sheet, if we do get a pause in the interest rate hikes, if they don't hike at all, that is going to be perceived as extremely dovish, and I think that the metals could really take off on that news. I mean, of course, who knows? The Fed could tell us anything. It's hard to say what they're going to do, but I think that they understand what is at stake here, and that is why I think they are going to opt for a pivot. Now, time will tell, but that's just my take. Let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.